So thank you very much for regathering. That was a great morning session. I'm Jonathan Parker of MIT Finance. Many of you know me. I'm pleased to bring this next session together. It's a session on risk sharing among households with some of the life cycle perspectives that I have been interested in through my whole career. So it was very fun to see these papers. And we're going to start off with Ciaran Rogers. I'm talking about risky insurance, life cycle insurance, portfolio choice, and incomplete markets, something that's near and dear to my heart. So every speaker is going to have 15 minutes. We'll do the same thing where there's a discussant, which discusses both papers for 15 minutes each, and then we'll have some time at the end for questions. So thank you very much. Ciaran.
Thank you. All right. Okay, good morning, everyone. Thank you very much for adding my paper to the conference. I'll just wait for... Okay, great. So this is joint work with Chris Tonetti and Joseph Briggs. So the background for this paper starts with the observation that although many households in late in life face significant financial risks, such as mortality risk and other health cost shocks, and the associated spending needs, many households late in life decide not to take up insurance against these risks, despite the fairly rich set of insurance products available to them in the US. So to illustrate this, I document for you the ownership rates of 3 insurance products that are items of key interest in this study, which are long-term care insurance, life insurance, and annuities across age in the US in 2015. And 2 observations jump out of this. Firstly, the holdings of these insurance products late in life are quite low, especially for long-term care insurance and annuities. And secondly, for life insurance, holdings are higher, but they decline precipitously with age as the life insurance is taken up to ensure the welfare of their children expires. So the observation here is that holdings are quite low. So the natural question that arises is why do households have these participation rates, these holdings? And also, what is the what are the welfare gains associated with these holdings? And to really answer this question, what we need a structural model to model these asset markets correctly. And in particular, what you need to include is you need to have the risks that households face, for example, health transitions as well as health shocks. You need to incorporate household preferences that might vary depending on the health state. And also you would need household constraints, for example, borrowing constraints, but also that they are facing real-world private healthcare insurance products, not sort of idealistic theoretical ones. And finally, that you model insurance that's provided by the government through Medicare and Medicaid. But the key innovation we have is 2 features. Firstly is that we model portfolio choice over these multitude of insurance products, and crucially under an incomplete market setting over a life cycle. And secondly, we want to measure and model this key idea of insurance non-payment risk, in particular the beliefs of households of this non-payment risk. And what we find is that firstly, from collected survey data, there is high perceived non-payment risk. In fact, it's largest for long-term care insurance, and then for annuities, and then the lowest is for life insurance. But secondly, we show through the survey data that perceived non-payment risk is highly predictive of actual insurance holdings, and in a way that's statistically significant but also quantitatively relevant. And then what we show is through the lens of the model. Once we incorporate these estimated non-payment risks, what we find is that these non-payment risks have a large effect on insurance ownership. In particular, they have a large effect in reducing insurance ownership. And secondly, what we find is that the welfare effects of underinsurance are actually quite small relative to what's otherwise characterized in the existing literature when you have complete markets. But instead, the welfare effects of these sources of market incompleteness, in particular non-payment risk and transaction costs, are in fact very large. So shall I continue? Oh, yeah. Just one sec.
Been working on it, so
okay, no worries.
if you're comfortable continuing.
Yeah, so what we do in this paper is firstly we have the data component. So on the empirical side, we collect survey data to elicit household beliefs of non-payment risk of annuities, long-term care insurance, and life insurance. And the reason why we collect survey data is that there isn't really, thus far, very good administrative data to collect actual non-payment risks. And also, what's important for household decision making is really about beliefs of households that drives their decisions on portfolio choice. And then secondly, what we do is, once we use those survey data to construct a life cycle model with portfolio choice over these 3 insurance products, but it's a world of incomplete markets. It's incomplete in the sense that we model products as they are in reality and as perceived by consumers. For example, the existence of perceived non-payment risk, as well as price wedges and quantity limits. So that's what we do in the paper. So let me briefly describe what we do in the survey. So in the survey, we make use of an internet panel study called the Understanding America study, which is a representative sample of the US population of 1,040 households. And what we ask these households, or what we try and elicit from them, is about their insurance product ownership. In particular, ask questions about 3 insurance products, long-term care insurance, annuities, and life insurance, and try and elicit their beliefs on non-payment risks of each of these products. Now, we just adapt the procedures of Lutler-Samwick, but what we try and do is the 2 key measures we want is the probability that the households believe that the contract will be terminated permanently, and then also we want to understand their distribution of annual payments from these insurance products conditional on a qualifying event occurring. And then we're going to repeat for different aggregate economic states, but we'll skip that for today. And we're going to use these measures for insurance product characteristics in the model. So what is the outcome of this survey? Well, the first outcome is that we're able to understand their beliefs on their expected payout of each of these 3 insurance products. So what I show you here is the expected annual payout, or the CDF of expected annual payouts, as a percentage of what you are promised on this product, conditional on a qualifying event occurring. So for example, for life insurance, this tells you what you expect to receive, conditional on you passing away, and what that pays out to recipients of the insurance. And what you can see here is that in red, for life insurance, on average, so 50% of households expect to receive exactly what they are promised with certainty. In other words, 50% of households expect with non-zero probability that they will get something less than what they are promised. So for life insurance, it's about 85 to 87%. And then this is even lower for annuities, and it's lower for long-term care insurance. And in some sense, this makes intuitive sense because for long-term care insurance, there is some ambiguity as to what is a qualifying event for you to receive the payout from a long-term care insurance, but that ambiguity is not so clear, in particular for life insurance. So these orderings seem to make some sense. And then when you look at full default probabilities, you also have the same ranking, but here what it's about is it's a likelihood that you get a permanent termination of the contract in each given year. And you can see here that many households assign a non-zero probability of this happening. In fact, they are material. They're over 1% for each of these products, and there's almost 2% for long-term care insurance. So what we want to do is, well, we now know that they have these beliefs, but are these beliefs in any way instructive as to how they make their portfolio choice? And it turns out that it is. So what we do is we try and we regress an indicator of ownership of each of these insurance products, indicator of ownership on these beliefs of insurance of non-payment risk, along with other control measures. And what we find is that beliefs of non-payment risk have a statistically significant effect on whether or not you own that insurance product. And what we show also here is that once you extrapolate from these regression results, where you say, let's suppose we're in a counterfactual world where there is no non-payment risk, do these regression results imply an increase in participation of each of these insurance products? And what we see is that, yes, indeed, it does have an effect. And the effect is particularly strong for long-term care insurance and annuities, where participation doubles if you're in a counterfactual world of no non-payment risk. So it seems like these things matter. But ultimately, we don't really believe that there is this sort of additively separable relationship between beliefs and actual participation in these products. What we need is a structural model to understand how these products relate with each other, and also to run some counterfactual analysis of terms of the effects on welfare, as well as other studies that we can use when we have the model. So what does the model look like? So it will be a life cycle heterogeneous agent choice problem, where each agent, each household of age 45 and above, is going to make a portfolio choice. It's going to consume and it's going to save in each of these 3 insurance products that I mentioned earlier, as well as bonds. And then individuals are going to be exogenously heterogeneous, or different in age, income, their permanent income quintile, as well as their sex and their stochastic health status, where there will be 4 health states. You can be in a good state, bad health state, you can be in this long-term care state, as well as death. And this follows a stochastic health Markov process. And then you also face health cost shocks that are dependent on your age, your sex, and your health state. And then we're also going to have non-homothetic health state dependent utility parameters that may potentially vary across states. And then also finally, as a consequence, individuals will be endogenously heterogeneous in their wealth, their insurance holdings, as well as the insurance premium that they face, and their government care status, in other words, whether or not they take it out. But what's really important in this model is really how we're defining insurance products. Because the whole goal of this model is that we want to characterize insurance products as they are in the real world. So what features are important here? Well, firstly, we want to have exogenous insurance prices that actually reflect the real world markups above actuarially fair values. So we take that from the existing literature for each of these products. And then what we're going to also have is that annuities, they're paid lump sum, mostly in the data, whereas life insurance and long-term care insurance are paid as annual premium, and that turns out to be important. And also we're going to have probabilities that A, the insurance product fully terminates, if fully defaults, and secondly, insurance products do not pay out fully in each qualifying event. And these are going to be taken from the likelihoods that we estimate from the survey. And then finally, we'll have an age limit on purchasing insurance products, because we see in the data that beyond the age of 75 or 80, it's difficult to increase your holdings of these products. And then when we estimate this model, we understand the model parameters. We choose a small number of parameters to match a rich set of moments on the wealth distribution, the average insurance ownership rates, and the survey responses to questionnaires trying to elicit their health state preferences that's done from work by my co-author in previous work. But what's key here is that we are not using the insurance product characteristics to match the data. The insurance product characteristics are taken from the survey as well as from the existing literature. So that's what's very important here. So what are the results? Well, firstly, this is what we're showing you here is the wealth holdings across age for the 25th, 50th, and 75th percentiles, where in red it's in the data and the blue is in the model. So we do a reasonably good job of at least matching the evolution of wealth across ages, across different percentiles. We're still working on this to make it a better match. And then importantly, what does it look like for insurance participation? Now, to make it clear, we're matching a small number of parameters just to match the aggregate holdings of these insurance holdings, not across age. And we do a reasonably good job of matching the age profile or the life cycle profile of ownership of each of these insurance products. But then the question you can directly ask is, well, what would be the ownership of these insurance products in a counterfactual world where there were no transaction costs and no non-payment risk? And you can see that these have really significant effects on ownership of these insurance products. And particularly it is the case for long-term care insurance and life insurance. In other words, these beliefs of non-payment risk and the transaction costs you face have a big major effect on your participation in these products. But then the next question that actually arises is, well, what are the welfare effects associated with the existence of these insurance products? And what we show in this table is that the welfare gains from having access to these somewhat imperfect insurance products is about 1.6% of consumption. And this is relatively small in comparison to other work that assumes the existence of you being under complete markets, for example. But here what we show is that in contrast, there are pretty significant welfare gains from getting rid of these non-payment risks as well as these transaction costs. So in other words, if you live in a world of having access to insurance products that have no non-payment risk and no transaction costs, the welfare costs are significantly larger, almost in the order of 6% of consumption. So the welfare costs of underinsurance are much smaller than a complete market setup, but the welfare gains of getting rid of these frictions can be quite significant. But suppose we live in a world where we have these beliefs and they're not actually rational. So households believe there's non-payment risk, but there is actually, in reality, insurers always pay out what they are promised. But even in this case, there are significant welfare costs associated with households having these now incorrect beliefs. And it's precisely because they are holding less than what they should hold if they instead had the correct beliefs that they will always pay out what they promise. And what we see here is, of course, this is a different world. What if we fix the beliefs of households towards being correct and not believing there's non-payment risk? There is still also significant welfare gains of almost 3% of consumption. So what I'm saying here is this somewhat gives you bounds of, what really matters for household portfolio choice is their beliefs. And whether or not, what is the policy implications? Well, it depends on whether or not those beliefs are correct. But this is giving you bounds that even if you're in a world where insurers do pay out what they're promised, there are still welfare gains from the fact that households believe there to be non-payment risk. Okay? And then we'll finally end with saying now, well, what does this model also give us? What does it also buy us? It also allows us to assess the complementarity across these different insurance products because we have a portfolio choice. And we look at the welfare effects associated with removing non-payment risk one product at a time. And we show you here that it's most important for life insurance and for annuities. But you can see here these sums to about 0.75%, but I showed you in the baseline that incorporating all three together improves your welfare by 1.6%. So it lends the idea that there's some degree of strong complementarity across these three insurance products, which lends us to believe that really having three insurance products together in this model is very important to understand overall choice of insurance products. So I'll just conclude and say that perceived non-payment risk is large in annuities, life insurance, and long-term care insurance markets. Incomplete markets and perceived risks are important determinants of insurance holdings, and measuring and modeling actual product features is important if we want to study both consumer choice and consumer welfare. And welfare costs associated with these deviations from optimal insurance portfolios crucially depend on the features of the products as well as the beliefs that consumers have of these products. So I'll leave it there.
Thank you very much, Ciaran. The next speaker is going to be Emil Verner, talking about household debt relief and something not about taxes, but a Laffer curve.
Thanks, Jonathan. Yep, thanks very much for having me. So this is joint work with the Gyozo Gyongyosi, and we're going to be looking at the impact of a major household debt relief program in an emerging market debt crisis in Hungary. The broad motivation is household debt relief is a common and often very contentious policy response to debt crises. And there's a range of different arguments you might have for wanting to do debt relief. One argument economists often make is that a benefit of debt relief is to alleviate household debt overhang, or debt overhang in general. So the idea is that high debt burdens distort the incentives to service debt and generate cash flows because those benefits may disproportionately benefit creditors. And so providing debt relief can potentially improve repayment rates and even boost economic activity. Now, this argument, of course, applies more strongly to households that have relatively high debt, where this sort of debt overhang margin might be most relevant. And so the benefits are likely to be highly heterogeneous across borrowers. And in extreme cases, there's this idea that debt relief could, in principle, even benefit creditors in some circumstances by increasing repayment rates. And so this notion of the debt Laffer curve, which relates the face value of debt, how much borrowers owe, to the net present value of debt, could be concave, hump-shaped, and even invert. And so borrowers who are on the wrong side of the debt Laffer curve, providing debt relief for these people would actually come at no cost to lenders. So in this paper, we're going to think about these questions. So we're going to think about what is the impact of household debt relief on repayment and borrower income. How does this vary across the full distribution of indebtedness? So what are the impacts of doing debt relief for people who have very little debt and aren't necessarily distressed versus people who have a lot of debt and maybe a severe debt overhang problem? And then we're going to think about, are there circumstances where the debt Laffer curve may actually invert in practice, and for what share of borrowers could this be the case? And our empirical setting is going to be a large-scale debt relief program that was implemented in a major household debt crisis in Hungary in 2015. So you should think about Hungary here as sort of a stand-in for an emerging market foreign currency debt crisis, a little bit like some of the crises we saw in the Southern Cone in the early 2000s, say Argentina and Uruguay. Households had borrowed expensively in foreign currencies, mostly Swiss francs. There was a big appreciation of the franc in the 2008 crisis and a depreciation of emerging market currencies like the Hungarian forint. And this led to severe household financial distress. And ultimately, the government, following some legal decisions, passed a debt relief program that provided a face value reduction of about 14% for over 800,000 borrowers. So we're going to use this setting and some variation that this setting gives us to provide a few findings about the impact of debt relief. So first, we show that, not too surprisingly, debt relief increases repayment rates. And this debt relief is going to increase repayment rates by about 6 percentage points, which is about 25% of the baseline default rate. So it's a very large effect. And there's also a modest effect on borrower income. So incomes go up by about 0.8%. Importantly, though, the effects are really heterogeneous across the distribution of indebtedness. So if we sort borrowers by how much indebtedness they have going into this program, then the effects are rising in indebtedness up until around the 80th percentile of indebtedness, and then they become much weaker again. So in other words, the effect of debt relief is strongest for highly indebted, but not the most extremely indebted borrowers. Then we combine the effects of this impact on repayment with banks' own assessed loss given default estimates to try to come up with an estimate of how many loans does the debt relief actually benefit the creditors for. And we find that for most loans, the slope of the debt Laffer curve is about 1. So $1 of debt relief implies $1 loss to the lenders. But there's this long tail of borrowers where the cost is substantially mitigated, and for about 5 or 8% of borrowers, depending on sort of which estimates you use, the debt Laffer curve might even be inverted. And we'll show you that, and I won't have too much time to talk about this today, but these findings can be rationalized within a pretty standard model of household debt overhang with long-term mortgages and default. And the key mechanism is going to be that for kind of very highly indebted borrowers, there is going to be this debt overhang channel where they're not going to be making payments, and so there's going to be wage garnishment, which is going to impose a cost on these borrowers. And so providing some debt relief for these borrowers is actually going to improve their incentives to service debt and generate cash flows. So let me very briefly provide some context. In many parts of emerging Europe up to the 2008 crisis, there was widespread lending in a range of foreign currencies, mostly Swiss francs, by banks who were competing for market share in kind of these new contestable markets. So in Hungary, 2/3 of mortgages were in Swiss francs, and this was done sort of during a time when exchange rates were very stable. But the crisis led to these big unexpected depreciations, and so ultimately, borrowers saw revaluations of their debts of upwards of 60%. So by 2014, the average borrower owed 30% more than they had initially borrowed roughly a decade before in local currency terms. And even though this is a really severe recourse environment, default rates became very high. So there was 20% default rates on these foreign currency loans. And this figure here that I'm showing on the x-axis shows a simple measure of indebtedness, which is how much do you owe in 2014 relative to how much you borrowed, say roughly a decade earlier, on the x-axis, and then the y-axis is the default rate. And so you see, there's this very strong positive correlation. So borrowers that, for example, owe 50% more than they initially borrowed, they would have default rates, of about 30%. So this led to kind of substantial political agitation for doing something about this crisis. There was a lot of questions about were these loans actually legal under Hungarian and also EU law. And ultimately what happened was the Supreme Court decided that there were some specific loan servicing practices around these loans that were unfair based on the EU's Fair Contracts directive. So the loans themselves weren't illegal, but there were some things that banks did which were. So for example, the banks would charge an exchange rate spread when you came and paid off your foreign currency loan instead of giving you the kind of the central bank official rate. And they also had unilateral interest rate changes where they would pass through changes in their funding costs into the interest rates that these loans faced because the loans didn't have pre-specified basis rates and spreads, which seems very surprising, but actually happens in some other contexts as well. So as a consequence of this legal decision, the government decided that they were going to provide a unified framework for how to settle these loans, and that was called the Settlement Act. That required banks to write down debt based on how big the excess payments were, and they had to do this in March or April of 2015. So debt for treated borrowers, as I mentioned, fell by 14% on average, and because there's so many foreign currency loans, you actually see this in aggregate debt to GDP statistics. They fell by about 3% around this policy because of the policy. So first we'll study the impact of this debt relief on borrower outcomes, and we're going to be able to leverage a few different research designs based on variation that comes from the program. So the first is we can do regression discontinuity designs based on program eligibility. Because this legal decision was based on EU law, if you borrowed before Hungary joined the EU, so before May 1st, 2004, this settlement wouldn't apply to you. So in principle, we have a control group of borrowers who borrowed, say, in April of 2004, and these borrowers wouldn't receive debt relief, whereas if you borrowed on May 1st, you would. Beyond that, we can use a variation in treatment intensity, and here we can leverage the whole population of loans, which is going to be nice to get some more statistical power. So here, essentially, we're effectively going to be comparing foreign currency borrowers who receive this debt relief to local currency borrowers who don't. And here we'll have over 800,000 loans in the sample. We can do this because we have household credit registry data that's going to be matched to administrative income records. That's going to let us observe essentially all borrowers and their both market and also transfer income from the government. So this here is the regression discontinuity design of the effect of the policy on debt. So this is just showing you that if you borrowed after May 1st, 2004, you saw a roughly 19% reduction in the face value, your principal, of your remaining debt, whereas if you borrowed before, then nothing happens. So then we can look at, well, what happens to default? So we can use the same variation, and this is looking at default a year after the program. Not too surprisingly, default rates are lower if you receive some debt relief. So here the estimate is about a 6 percentage point reduction off of that initial default rate of about 20%. Then we can go and we can use the much bigger sample and say, well, how does this really vary depending on how much debt you have? And so the basic measure of indebtedness I'm showing you here is based on how much do you owe relative to how much did you initially borrow. We can also look at debt to income. We find similar results. And what you see is debt relief lowers default rates, essentially for everyone. But the effects are much stronger if you're in the sort of third and fourth quintiles of indebtedness. So say you're at the 70th or 80th percentile of indebtedness, that's where the strongest effects are. And then interestingly, once you get to people who are extremely indebted, then actually providing debt relief for these people isn't going to do as much in terms of their default rates because presumably they're quite far away from their default threshold anyway, so you haven't provided enough relief. Then we can think about, well, what is the impact on income? And here, what's interesting is the impact is potentially theoretically ambiguous, right? So if you give me debt relief, well, on the one hand, now I feel richer. And so maybe, I was taking a second job to try to service some of my debt, but now I don't have to do that because my debt burden is lower. And so maybe I actually might work a little bit less and, enjoy some more leisure. So if there's kind of complementarity between consumption and leisure. On the other hand, right, there's this idea of debt overhang, right? That if you reduce debt burdens, then you can actually relax that problem because all of a sudden now I benefit much more from my work effort, and so I'm going to actually work more. In this context, so Hungary, like many European countries, is a full recourse environment. Wage garnishment is very widespread. Actually, wage garnishment rates can be up to 35%, and borrowers who default do get their wages garnished. Actually, that's the main way that banks are recovering on these loans. And so you can see that actually, this debt overhang channel might be potentially very relevant. There's also some ideas that, people might just become more productive for rational or even behavioral reasons if they have less financial distress. And so that might also boost their income. So when we look at in administrative income data, what this debt relief program does, we see that actually there's a modest but actually quite persistent increase in income. So I'll talk about the magnitudes and why they're not huge, but they're still non-negligible. What you see here is essentially comparing the evolution of income for borrowers that receive a lot of debt relief relative to borrowers that receive little or no debt relief. It's similar up to the policy, and then there's sort of this gradual increase in income over the next 1 to 2 years. And in terms of magnitudes, if you, for example, provide 20% debt relief, that translates into a 0.8% increase in income on average. In the model, we show that actually this is consistent with a relatively low fish elasticity of labor supply. So it's not like people are very, very reactive to this policy, but nevertheless, there is some response on the income margin. Okay. Great. So we can also do the same sort of heterogeneity, right? So this debt overhang channel for income might be stronger for people if they have a lot of debt. And here we find similar results as on the default side. So the strongest effects on income are for people who are in the third and fourth quintiles of indebtedness. So if you have very low debt and I give you debt relief, if you're in the first quintile here, nothing really happens in terms of your income. And if you're extremely indebted, you're in the fifth quintile, there's also a much weaker response. But if you're kind of in the upper middle echelon of that distribution, then you're going to respond more. So then we try to think about, well, what is the impact of debt relief on the value of these loans from the perspective of the lender. So kind of back to this classic idea of the debt Laffer curve. One way to kind of think about it from an intuitive perspective is think about a simple static valuation. The value of debt is the value of repayment, so 1 minus the probability of default times the face value of debt, plus the probability of default times the face value of debt, plus 1 minus the loss given default. That's the value in default. So suppose I provide some debt relief, so I'm going to move this value by changing the face value D. If there's no default, or if the loss given default is 0, well then every dollar of debt relief I give is going to reduce the value of the loan to the lender by $1. However, if all of a sudden there's default, and if giving debt relief actually moves you on the margin, then the slope is potentially going to be less than 1. And you can sort of intuitively see that if you can find borrowers who are very elastic to debt relief, who are all of a sudden going to start paying a lot if you give them debt relief, and the loss given default is very high, then all of a sudden maybe the cost might become much lower. So essentially what we try to do is we try to flexibly estimate heterogeneity in the response to debt relief based on this program to construct counterfactual probabilities of default with and without the program, and then do sort of a simple valuation exercise that says what is the value of each loan with and without default. And here we use the fact that we have the bank's own reported loss given default estimates. And when we do that, we can plot the slope of the debt Laffer curve, which you're seeing in this histogram here. And what you see is it's close to 1 for most borrowers. So not surprisingly, banks really hated this policy. This figure tells you why. But there is kind of this tail of borrowers where the cost is much lower than the face value reduction, and it inverts for about 5 to 8% of borrowers. And these are the borrowers who are kind of right on the margin where debt relief can kind of shift you and actually improve repayment rates. And that's very valuable to the lender, but ex ante it might be difficult for the lender to find these borrowers. So in the paper, we showed that this is actually very consistent with a reasonably standard dynamic model of mortgage debt overhang. In the interest of time, let me just conclude. So the exercise here was to look at sort of a major debt relief program and a sort of stand-in for, I think, a classic kind of emerging market foreign currency debt crisis. The effects are really heterogeneous, but there are improvements on repayment rates and income. And the impacts on the value of these loans for lenders are very heterogeneous. Now, thinking about policy implications, right, I think it's pretty clear. Actually, what you want to do here, if you can do some targeting, is look for debtors that are highly, but not necessarily the most extremely indebted borrowers. And lenders might not necessarily want to do this themselves, even if it's in their own interest ex post, because ex ante they might have a hard time actually targeting who those exact borrowers are, and they might be worried about moral hazard or even kind of reputational or fairness concerns. Beyond that, once you start thinking about debt relief and potential kind of externalities from doing debt relief, there's some things we haven't considered that we're thinking about going forward. So one is there might obviously be potential beneficial GE effects, either through housing values or through local income and local labor markets. And those have to be sort of weighed against the losses to creditors from reduced credit supply. And maybe even moral hazard. We know in many developing countries, debt relief programs get implemented a lot, and so they get sort of baked into expectations about credit supply. And that's obviously a cost of doing this kind of discretionary policy too many times. Thank you.
Thank you very much, Emil. Our first discussant is Kjetil Storesletten.
Thanks for inviting me. I'll start with Emil's paper. And by the way, it's not Emil, it's Emil. And then I go on to Ciaran's paper. Could you put the slides up? So, this paper asks a number of questions. I think the most important one is to try to understand how debt affects effort. So more generally they ask, what's they're looking at an experiment and they want to know how does the debt relief how does it affect households who have endogenous outcome? And then the next question is how could it be Pareto improving if you just ram through if we force banks to force the lenders to impose haircuts on the loans? I think the main contribution here is to provide causal evidence on debt crowding out effort. So there are two notions of debt overhang out there. One is from corporate finance, where if you have a lot of debt overhang somehow makes the borrower do suboptimal things. There are some investments they could do, or there's some effort they could do that would increase income, but they don't do it because they have so high debt. Then there's another more extreme notion of debt overhang. It's from the sovereign debt literature. It's Krugman, 85, where the debt is so large that it would actually, if the lenders could just give away some of that debt, that would improve the effort, but it would actually increase the present value of the outstanding liability. All right. So the setting here is Hungary. So many households took up foreign exchange loans, or Swiss franc loans, basically, before 2008. That was when the forint was strong and the local interest rates were high. So the forint is a classic carry currency. Higher interest rates on average, and very cyclical. So during good times, the exchange rate is strong, and during crisis, it tanks. Now, those bets, the foreign exchange bet, they backfired after the financial crisis. So relative to the Swiss franc, the forint fell by 40%. Think about that. That's pretty big if you have a large loan. And then eventually the government intervened and forced the lenders to accept an exogenous haircut on the debt. Now, was that a good idea? And more in general, should encourage governments to intervene ex post in debt markets? I think the answer to both those questions is no. So let's just think of a very simple model, just to clarify. So imagine you have defaultable debt and endogenous labor income, just to set. Now, assume that the borrower has a large initial debt and could default at a cost. And income is endogenous, so the borrower can exert some effort that's costly for a wage. The problem now, if the debt obligation is non-contingent, then that is an implicit tax. You have a 100% tax. The lender would just garnish the wages. It's a 100% tax until you repaid all the debt, and then you'll be the residual claimant. It could be for the borrower, it's actually better to just take the consumption floor and do zero effort. That gives you a debt overhang in both effort, but also there's also a debt Laffer curve there, where the value, if your debt is above a certain level, the value of the claim falls to zero. Now, imagine in that world, what would be the optimal contract from the point of view of the lender? It's very simple. You just give a haircut, so that the borrower is exactly different between not working and working. That's the maximum you can extract from the borrower. And if the debt is above that, you give that haircut. If the initial debt is below, you give zero haircut. So it's like a lump sum tax. So that's the first best. Fantastic. So in equilibrium, if you allow for optimal contracting, in a very simple form, there's effort is increasing in debt or non-decreasing, and there is no debt overhang. So we have to add some spice. So imagine what you need is moral hazard. Imagine there is something the borrower cannot see. It could be, say, human capital investment or something like that. Or just to make it simple, imagine the borrower is unemployed and the borrower can make a search effort, and we cannot see how hard they search. We can see if they find a job or not afterwards. And imagine that the borrower has a consumption floor. Could be from default. Default is not possible actually in Hungary, but imagine there's some social welfare that gives you a consumption floor. It's going to do the same job. Now there's going to be a trade-off between incentives, between insurance and search incentives. And efficiency here turns out, if you have large debt, the optimal contract is going to involve a haircut, and then that the lender is going to give a volunteer haircut, and that Surprisingly, effort is going to be falling with debt, if the debt is sufficiently large. So effort, the constrained, efficient effort is going to be hump-shaped in the debt. That sounds very surprising. Here's the reason. So imagine now, that's it. Okay. So imagine the planner decides your consumption if you're employed, or your consumption if you're unemployed. That the planner can, but the planner cannot see how much you search. So the agent or the borrower now is going to maximize the expected utility of search minus the search cost, WP. All right, so we know how to solve that problem. We differentiate with respect to the probability of finding a job, P, of the search effort. And it turns out that the optimal search efforts, the marginal disutility of search, is the difference in utility between if you find a job or if you don't find a job. Good. So now that means that the planner or the bank can implement whatever search they like. They just make the difference between the value of finding a job sufficiently high relative to the value of not finding a job. So you basically, if there were no floor on consumption, you just force the borrower down. You just lower consumption, and then you can both get paid, and you make sure that the borrower exerts the optimal effort. Now, suppose there's a limit on that lower consumption. That means that if the debt is very large, you can implement a high effort, but that's going to be that's going to be very costly, because so what's going to be optimal for the borrower from the lender is just to actually lower the incentives if the debt is very large. And so the constrained efficient outcome here is that you're going to have hump-shaped effort. The efficient outcome is that the effort will be hump-shaped, but note that there's no Krugman debt overhang here, because the lender would never not do the haircut, right? So what you need in order to get a debt overhang, debt Laffer curve, you need somehow that the lenders are not able in the sovereign debt. They assume that the lenders are not able to coordinate, or there are some holdouts. But in a setting with a bank, that doesn't seem right. The bank would never leave money on the table. So what would happen after debt relief here? Well, imagine the borrower has temporary experiences a lower default cost. Now the borrower goes to the lender and says, my plan to default. And the borrower says, oh, wait. I'm going to give you a haircut, and that's going to make the borrower stay. The outcome is going to be lower debt, lower default probability, and possibly a larger effort and larger income, exactly like what Emil and his co-author find. But there is no debt Laffer curve here. All right. Okay, so there's no role here. How much time do I have? Okay. Okay, so there's no role for government ex post intervention here. The allocation is already constraint efficient, unless, of course, the government could somehow deal with the underlying moral hazard problem. That would be fantastic. Or they could lower the consumption floor. Now, what would be the motivation for the government to do this? Well, it could be that they just want redistribution from foreign lenders to domestic households. Now, that motivation is always there, but it's not clear that efficiency calls for that. Back to Hungary. Why didn't the banks just on their own give that haircut to implement efficiency? It's unreasonable, I think, that the banks would just leave money on the table. But it could be that the households and banks were anticipating that there was going to be some government intervention. In fact, there was already another reform in 2011, so not unreasonable that they would think that something would happen. Okay, the problem with export debt relief is that the policy is going to crowd out optimal private markets. Why did the Hungarians get there in the first place? Well, reckless lending and reckless borrowing with bad luck. So the problem is, if you anticipate, if you do a policy like this, that's going to create expectations. If you anticipate debt relief, that could actually make things worse, because you're going to delay this. Now, that means that from a policy point of view, debt relief is useless, because it will only work if it's totally unexpected and you're never going to do it again. So I think a much better solution in the Hungarian context is just to ban foreign exchange borrowing altogether. And there might be some agents who need hedging exposure for hedging motive. You could do that, achieve that through, say, encouraging option markets, to call options. Okay. I really like this paper, the second paper, the risk insurance, life insurance. The idea is, very few people buy annuities, life insurance, and long-term care insurance. Their theory is simple. They want to check if perceived non-payment risk is what causes that. So that goes back, let me see, where are you? Peter made this point yesterday. The problem is choice and trust. I love that. So they are trying to figure out the trust part. Is that what drives it? That's easier said than done. So they need to do things. First, they try to measure the amount of trust, and then to put it, and then to try to ask how quantitatively how it matters. So the measuring part is that using data from this novel data from this Understanding America study, and they find, yeah, a lot of people believe they will not be paid. Now, let's put that. How do we put that basically? How do we figure out how much that matters? Well, unfortunately, we cannot do that with regression analysis. It has to be in a structural model. If you think of David, where are you? David's paper in the previous session. You know, when you have to look at how if we could somehow affect beliefs, it's gonna influence the selection of customers and affect prices. And you need a structural model to have a chance of doing that. So what they do that, they build a huge machine, cutting edge quantitative life cycle model with a lot of bells and whistles. Okay, I'll be quick. I'll just say that I'll emphasize one thing. So they do this using what they call exogenously incomplete markets. That sounds like a cheat, but all the prices. So it's exogenous in the sense that they restrict the number of instruments. But given those instruments, they do take into account the selection into each product, etc. Okay, then they ask. Let's then use your model to ask to quantify the welfare gain of removing that perceived repayment risk, and they find huge effects on life insurance and long-term care insurance. Interestingly, they find that fewer people would buy annuities. How can it be? Well, the reason is, as he said, there's an interaction here between these insurance products, and that's why you really need a model to answer this question. There are two stories. Could be that households are wrong and they have irrational beliefs, or it could be that they have the right beliefs. I think we should only believe in the first story. With the second story, regulatory guarantee solves that risk. And it's very easy to verify, for example, death. In fact, and you would see if those products were giving, if you could just promise long-term care insurance and you could just cheat people afterwards, there would be abnormal profits there, and you would see a lot of entry. In fact, you see in the opposite, that you have insurers leaving. That because probably because they set too low prices in the first place. What's the policy advice from this? You need an information campaign, and we need to regulate to make products simpler and more comparable. Sorry for going a little over.
Thank you very much. That's an enormous trust you have in government regulation, just solving the problem.
I come from Norway.
Yes, okay, good. Yes. Good, all right. Well, our next discussant is Lesley Turner. Thank you very much, Kjetil.
Great. So I really enjoyed reading these papers, and I appreciate the opportunity to discuss them. So thank you to the organizers for including me in this conference. So I'll start in the opposite order. I think this paper was a really nice complement to the discussion that occurred in the last panel yesterday evening. I think was already mentioned. It deals with implicitly issues of trust in these products. It also deals with the correlation between, or the interrelationship between decisions of buying life insurance, long-term care insurance, saving for retirement. These are not decisions that are made in isolation. And I think one reading of the beliefs that respondents are giving around the likelihood of these insurers not paying out could come from a behavioral story, or at least a story about frictions, which are things that we, traditionally were not in these models, but potentially are very important, both when we think about understanding take-up and then also sort of broader policy implications. And so I think this paper, the really broad question is how perceived, whether or not it's the actual non-payment risk, how this affects demand for products that provide insurance against old age risks. And so I think in general, when we think about risk in a setting of insurance, we're thinking about the individual's own risk, but now we're introducing this additional risk that the insurance provider fails to make a payment. And I actually think there's an open question, but my read of the paper and from some very basic investigation is that the perceived non-payment risk is quite a bit larger than the actual risk, although I think there's more investigation needed here to understand where these perceptions are coming from. And then this non-payment risk, the perceived non-payment risk, is incorporated into this life cycle model. And I think the really nice part here is it allows for a comparison, an implicit comparison, of the relative role of perceived non-payment risk versus the wedge due to prices exceeding actuarially fair prices. And what comes out of the model is that the perceived non-payment risk has a larger role in sort of explaining take-up and sort of consumer welfare that's left on the table versus this price wedge. I think that's a new insight. I think this idea of non-payment risk is new, and then sort of being able to benchmark it against another friction in this market that we often think about is very nice. And so I think the findings, even before we get to the model of these perceptions of non-payment risk, are super interesting. And I just want to know more about what's going on here. Basically, are people making mistakes? And I think, I likely land on the answer being yes as well. The empirical risk of full default, so an insurance provider just sort of exiting and saying, I will not pay out on this contract, I think is probably pretty close to zero. And we can see in sort of correlations between other measures that are collected in this survey that this sort of perceived risk is correlated with financial literacy. So individuals who are have lower financial literacy perceive a higher risk. It's correlated with cognitive ability. So higher cognitive ability perceive a lower risk. These are things that suggest people aren't able to understand these complicated products, and they may be not understanding the actual risk. On the other hand, all of these adults have lived through the financial crisis. At one point, providers of life insurance products looked like they may sort of default on these products. It ultimately didn't happen. There were sort of bailouts and sort of other interventions that prevent this from happening, but there was the possibility that life insurance products would not pay out. And sort of also from this survey, the perceived risk is correlated with past experience with fraud. Now, that may not be indicative of the actual risk, but it suggests people are learning about sort of these financial markets. And so I think there's potentially more to be done just with the data that you have right now. I want to understand like 4 different causes of this perceived risk, whether it be real or sort of due to frictions or lack of information. Do those causes generate predictions about heterogeneity in perceived risk across these products? So like one very clear potential source of heterogeneity, which is brought up in the paper, is that annuity payments, life insurance, sort of the event that triggers payouts is very clear, easy to observe, hard to contest, right? There's still the risk of the company going out of business, but there's not a risk of like not qualifying for the payout, versus with long-term care insurance, this is a little bit more opaque, whether or not the person has entered into this bad state of the world. There may also be a hassle cost associated with verifying the qualifying event. So what sort of information has to be provided? And uncertainty. So everyone knows they're going to die, which will trigger a life insurance payout. Everyone sort of knows I'm alive this year, I'll be likely alive next month, that will trigger an annuity payment. But sort of health risk, people likely have private information, but there's still a lot of uncertainty over whether they're going to qualify and what the time horizon is. And so these might also sort of be implicitly entering into this perceived risk, even though that's not what you're asking about. These are complicated calculations. And so I think if there was desire to push more on these questions, you could collect additional information on these other types of frictions and see to what extent these are correlated with the perceived risk. And so, the implications for policy, I think, kind of depend on where these perceptions are coming from. Are they accurate? Are they due to simple misperceptions that could be easily corrected with information? And in the model about the role of government, and in particular, sort of the difference in the government backstop. So I think in the model currently, there's a consumption floor that comes through the government social insurance programs, but it's also going to be state dependent, right? So Medicaid, long-term care insurance kind of minimizes the downside risk of your long-term care insurance through private providers failing to pay out. There's also running around the background sort of the risk of non-payment or reduced payments through Social Security. So is that correlated with perceived risk of non-payment for these private insurance products? And then I think, this is sort of outside of the actual variation that exists, but I would be really interested in exploring how these perceptions interact with the generosity of the public option. So if Social Security, we lower that consumption floor due to Social Security in the model, does that change anything noticeably? If you sort of allow for this Medicaid long-term care benefit, how does that interact with these perceptions? Is there sort of money being left on the table because of the generosity or lack thereof of these public options? And then thinking also about spillovers to the taxpayer. So for instance, if by correcting these misperceptions, we could increase private long-term care insurance coverage, that, I believe, would have positive spillovers to the taxpayer because it would reduce reliance on Medicaid long-term care. There's some complexities about spending down of assets, but there are these interrelations. And so thinking beyond just sort of consumer welfare, but sort of a broader sense of social welfare. And then finally, distributional considerations. So my guess would be that there's correlations between misperceptions and sort of income or wealth, and that's going to lead individuals who are lower income to be more likely to make mistakes and sort of bear the brunt of these welfare costs. On the other hand, these public options are sort of more generous on a replacement rate standard for income individuals. So it's not clear to me which way this would go, but I think it would be an interesting extension. But overall, this paper raises some really interesting questions, provides just really basic new knowledge about a factor that we're not considering when we're thinking about insurance take-up in old age, and I think could be very important for how we think about these questions. Okay, so I'm going to now talk about the second paper. This is, a really, really nice paper. It mixes very good causal identification with sort of state-of-the-art methods with a structural model to answer a question that I think is often posed, whether or not there is money being left on the table in terms of modifications to existing debt contracts. Are lenders actually realizing this? Are they taking advantage of this? And get some traction on this question. My background, or my research interest is focused on student loans. And so I think I see many student loan nails for my hammer, but this paper really struck me as maybe broadly speaking to questions that are ongoing around efforts to forgive student loan debt in the US. In particular, this view that there are these potential spillovers that we're not thinking about, so sort of benefits to forgiving debt, even if sort of the costs in terms of lost revenue are non-zero. And in particular, this paper shed some really nice light on the labor supply channel. Okay, so I think the main question I see of this paper is how does the cost to the lender of principal debt forgiveness vary with the face value of debt? I think it's a nice case study of Hungary. There's sort of details that are more specific to Hungary. I also look at this from a US perspective, so things that are different. Limited options for foreclosure, very high wage garnishment, both sort of access to wage garnishment and the rate of wage garnishment. And then we've got this nice variation in principal forgiveness due to the date of origination. And so the main results are just that on average, debt relief reduces the likelihood of default and leads to smaller, but still I think important increases in earned income. This is sort of very heterogeneous across borrowers. And something around the sort of benefits or costs to the lender, but thinking about a broader set of outcomes that might be affected here. I think in the US, we worry a lot about the cost of foreclosure, and there's a benefit to reducing foreclosure. That's not going to be an issue here. But there is evidence in this companion paper about aggregate spillovers to local economies that were more or less exposed to this debt forgiveness. And then, moral hazard. This is sort of again, a case study, a one-time debt relief program. But if we think about sort of policies more broadly, we have to think about moral hazard concerns. Yep. I would love to see more along these lines on thinking about sort of the social costs and benefits. In particular, sort of tax revenue. So there's additional tax revenue generated because of the income response. I was surprised to see that there's no effect on transfer income. I'm not sure what this is sort of capturing, but you would think with a reduction in unemployment, you would see a reduction in unemployment insurance benefits. And so these are important things when we're thinking about social welfare. And then, going even more heroic, are there policy counterfactuals that you could look at? So sort of thinking about varying the amount forgiven, maybe there is some quasi-exogenous variation that exists in your data that you could use. Is this equivalent to a sort of maturity extension or a reduction in payments? Is that going to vary across borrowers? Could this have been achieved through sort of not principal forgiveness, but just extending the length of repayment or changing terms? Can we think about changes to wage garnishment policies, and then targeted forgiveness for that 5 to 8%, or targeted forgiveness for a broader set, so sort of those up to 20% with some sort of subsidy to lenders to compensate them for the fact that above that sort of 8%, they're going to lose some money, but not dollar for dollar. But really nice set of papers, and so thank you for the opportunity.
Thank you very much, Lesley. We'll now open the floor to questions or comments on the papers. Debbie?
I really enjoyed the papers. I wanted to follow up on some things that kind of Lesley touched on a little bit, but I think it's really I want to talk about it from the government side, which is when governments decide whether or not to help fund the forgiveness. I think a first order issue is that forgiveness is helping often the banks as much as the lenders. And so if the government also has the liability for the deposit insurance, or, for the banks, then they have to think about it beyond the welfare questions of just the individuals. And somewhat related to, I guess, what Kjetil was talking about, I also presume that the banks are kind of efficient, but I think there's regulations on banks that makes it very hard for them to do forgiveness. And in particular, if they forgive a loan, they have to write the loan down, and that can trigger all kinds of capital requirements exactly when they can least afford to raise the capital. I think one thing, I just want to mention that during COVID, I was really struck by the fact that countries basically waived the requirements on banks to write loans down, and that's what accommodated the massive amounts of basically bailouts of borrowers. And maybe in COVID, we avoided the mistake of the financial crisis. Well, I don't know if it was a mistake, but what happened during the financial crisis is we wound up letting mortgage borrowers bear bankruptcy costs, but then the banks still had to deal with the bankruptcy. So in COVID, I think there was more kind of proactive, let's bail out the borrowers, and it did have the effect also of helping the banks, but the banks could only do that with that policy change in the requirements. So I guess it's more of a comment than a question. But
Yeah, no, I think those are actually great comments. So on the second one around the regulatory friction, so actually there's a case study, and I'm forgetting the bank, I think it was UniCredit, did a big unilateral debt relief program for these loans in Romania. And basically the problem that they had with the ECB was that it effectively, they had to write it down on the asset side, and the ECB wouldn't recognize that now these loans were better performing, and so it affected them on their capital requirements side. So actually there's a concrete example of that. And then I like the idea that the government has to think about financial stability more broadly in the deposit insurance system. That's actually one GE or externality I hadn't thought of. So kind of the other externalities I usually think of are maybe there might be some demand externalities that banks don't take into account. We showed this in our other paper. There might be some benefits and stability in the housing market, and banks aren't individually going to take that into account. But the same for the kind of broader stability and cost of the banking system and having a bailout, there might be that indirect benefit, yes.
From Janet?
Question for Emil on the loan forgiveness. And this comes up in a number of settings where there's been loan write-downs for one reason or another. And the income result is always very intriguing, and to think about what the mechanism is for that. So there's one thing that comes up often is whether the increase in income you're observing is just an increase in formal income, because the threat of wage garnishment is only for formal income. And so faced with that threat, people have more informal income, and when the debt is reduced, they switch out of the informal economy and back to the formal economy. So wondered if you could comment on that. And then the other thing that comes up is whether the reduction in debt increases access to other kinds of credit. And so it's sort of another way in which households may become sort of part of the formal economy again. And in some cases it's relevant, in some cases it's not. For example, in the financial crisis, the proposals For debt reduction, we're just too small. People would have still been underwater and wouldn't have been able to access much more formal credit, but maybe it was different in this case.
Ben?
In the insurance paper, there were 3 categories of insurance, and I think the delineation of death being certain, annuity being you survive a month, and the long-term care, it's more ambiguous. But there are other dimensions that would describe the insurance policy at the level of the person taking it out. So for example, there's the credit rating. So if you have a life insurance policy from a junk insurer, even though you're certain you're going to die, you're not certain that you're going to get paid to the same way. Similarly, there are other insurance companies which make a point of managing their brand in a way to make more certainty of payment. So in the property casualty space, Chubb is well known that if you have a problem, they will pay you quickly. They charge a higher premium more than many other insurers, but they are a high service brand. So I'm wondering, as you look at those categorization, if you could make it be more granular by looking not just at the category level, but within the category, the characteristics, credit or reputational, that delineate the insurers.
Yeah, sure. Maybe so. Yeah, no, this is a great point. So the way you're right, the way in which we characterize these in the model is some way simple. It's not characterized in a way that's bespoke, depending on the person who offers the product as well as the household that takes it on. And these roles are very important. I suppose what we're trying to do is taking the first step of saying, firstly, this model, the structural model we have, has a lot of elements to it, a lot of incomplete features to it. So adding other features would be quite cumbersome. But it's also what we want to capture is these basic features of these products. They pay you out in certain qualifying events. Just characterizing them based on health state dependencies. What does the model say for ownership of these insurance products? And that's why we really talk about participation. Now, when we talk about, we don't really talk about the intensive margin, because that will now speak more to this kind of the particular characteristics of the products that are offered to each individual household. So the main answer is, A, the model is it's quite involved already because of the incomplete features. And secondly, we're really trying to capture the basic characteristics of these products in that they just pay you out in certain health states of the world.
David?
Can I respond to
Okay, yeah.
on the formal, non-formal, that's a great point. So actually the informal economy is big in a kind of country like Hungary, especially in the non-tradable service sectors. And I think that's definitely a part of the story. It's hard for us because our income data is from Social Security contributions, so you don't actually see that. One thing that we have done though is we look at workers who are in occupations and sectors, like especially manufacturing, where informal work, they're often working for like major German or other foreign multinationals. And even amongst those workers, we actually see improvements in income. But a big part of what we find in the income side is flows from unemployment into income, and that could be coming from informal work. And so then we would be overstating that. So yeah, all the results are about formal income. On the access to credit point, we looked at that in the paper. Actually, we don't find right now major effects in terms of new borrowing subsequently. Partly it is that these borrowers, they receive some debt reduction, but many of them are still underwater for the reasons that you said. But also people debt to GDP is 35%. Household debt to GDP is 35% in this context, not 100% like the US. So people use credit and debt less than they do in the US. And so I think that could also explain it.
David? Well, we should do a last question because I think we've run a little over, but go ahead.
Yeah, sorry, I'll just be very quickly. Just that, for Emil, I'm curious about the relative efficiency of sort of debt write-downs versus liquidity, because my lesson from the Great, I like Lesley have a U.S.-based focus. I apologize, but what I drew from the research coming out of the Great Recession was that actually providing liquidity to constrained borrowers is way more effective at mitigating foreclosures, and default. Whereas you're showing you actually find some effects in default. So I'd be curious if you could speak to that. I'm thinking about the HAMP program.
It's a good question, and it's one that we're naturally going to get. So Our setting isn't well suited for separating liquidity versus wealth because we don't have variation in liquidity and wealth. This is kind of a face value write down. What I will say is many of the studies that looked at liquidity were looking at people who were really underwater, and then you tell them, well, in 10 years, you're gonna have a lower payment effectively. Yeah, I'm not so surprised that that doesn't lead to big effects in terms of repayment. Here, we're finding effects for even people who have sort of moderate levels of indebtedness, and that makes me think that some of these balance sheet constraints might also matter, like you actually see in unsecured debt settings in the US, like for example, work by Will Dobie. So I don't wanna come down too strongly either way, but I still think that stuff beyond liquidity, balance sheets matter.
So thank you very much. This session has definitely touched on a bunch of policy, finance and policy issues, and issues that the Golub Center has been deeply involved in lately. So one is the sort of mortgages and the roles of liquidity and stabilization, those sorts of policies. Is that working? Okay. And then the second, we think a lot about the way that governments ought to evaluate and monitor and regulate and measure financial risk in institutions. With insurers obviously being a first order one, and getting that right seems critical because we don't want to be taking any of the policy advice that we tell people these policies will pay off, and then exactly in the states of the world where they need the most, they don't, as an aggregate shock, which is exactly the sorts of aggregate risks that the government needs to price correctly on the balance sheets of these institutions. So thank you very much to the participants and the discussants. We have a short break now.